Don't make drastic moves whenever you see a headline of the Fed raising interest rates. It's more than anything important to understand how interest rates work, how interest rates affect you. It's important to have a plan in place on what you're trying to achieve in life financially or personally, and how are these rates going to affect your ultimate financial plan. Welcome to Wealth in Progress, the weekly podcast for professionals in their 30s and 40s trying to build wealth while juggling careers, family, rising expenses, and the occasional panic after scrolling social media for 5 minutes. I'm PJ, founder of Wealth and Plan, a virtual financial planning practice serving clients nationwide. If you want to learn more or start a conversation, head over to wealthandplan.com. We are currently accepting new clients and would love to get to know you. Here is this week's episode. What's going on, everybody? Welcome to episode 5 of Wealth in Progress. I'm PJ. I'm a financial planner for young professionals in their 30s and 40s. And in this week's episode, I wanted to talk about interest rates and specifically how do interest rates affect you as an individual, as a consumer. And without further ado, let's go ahead and jump in. So first, before we even get started, let me define what interest rates even are and how they're determined. So to put it in simple terms, an interest rate is simply the cost of borrowing money. You might hear headlines out there that the Fed is going to raise interest rates or lower interest rates. And essentially, all that means is the Fed sets a baseline rate that the banks then charge each other, and the rest sort of flows down to the consumer. Things like credit card interest rates are then set, mortgage rates, car loans, savings accounts, even. Everything just kind of trickles down after the rate that Fed sets. Now, there's different measurables to set certain rates. For example, just because the Fed lowers the interest rates by 25 basis points or 0.25% does not mean that mortgage rates necessarily are going to drop by that much immediately. They sort of work off a 10-year treasury note. So the rates are based off of different variables and different measurables out there, but the flow down from the Fed over to the consumer very much is relatable. Essentially, when the market's hot, meaning there's a lot of activity, a lot of spending, you might have kind of seen that after COVID, where lots of people are purchasing homes way over asking price. You start seeing trends such as inflation rising. And so, what the Fed will do in that situation is they'll raise interest rates to slow down the economy. Essentially, they're trying to limit inflation, limiting that spending to where, it gets out of control. On the other hand, whenever the economy is running slow, there's not much activity, people maybe aren't buying homes, aren't buying cars, aren't making big purchases, then what the government is going to do, or the Fed, they are going to lower interest rates to encourage and to stimulate the economy, right? So that's kind of the reasoning on a high level why the Fed would raise or lower those interest rates. So then now you as a consumer, how does it affect us? Since I'm a consumer as well, how does it affect us whenever rates rise? So the biggest thing, again, as mentioned earlier, is things typically get more expensive, right? They're trying to curb the spending. So if you're purchasing a new home, you're going to think twice buying that home if the interest rate is higher. If you're buying a new vehicle, you might not want to pay a double digit interest rate on a new car. So everything gets a little bit more expensive for us as consumers when interest rates are high. Those are kind of the downsides of interest rates being higher. There's also pros of having a higher interest rate. One of them might be you can actually have a savings account, a high yield savings account, earning more dollars or more interest than it did before. So, for example, if you have some cash laying on the side as your emergency fund, if interest rates are higher, a good idea is to place your cash in a high yield savings account and have your cash earn something during that environment. For example, after COVID, whenever interest rates shot right up at 2022, you could have a high yield savings account in a range of about 5% annualized. In other words, that's just the percentage that you're earning on cash. When interest rates are low, it does not really make sense to do that because there are other vehicles out there that might give you a return that's a little bit more competitive. And so it eliminates, the need or the use for a high yield savings account working for you during that time period. On the other hand, what is the effect of lower interest rates? Obviously, the most prominent one is that everything becomes more affordable in a way. So mortgage rates are lower, right? So you might be more inclined to go out and maybe purchase a new home or maybe refinance a mortgage that you currently have. If you bought a house in the last, call it 3 to 4 years, your interest rate might be in the 5 to 6% range. If interest rates go down, it might be beneficial for you to refinance your mortgage to a lower rate. That happened a lot during COVID when mortgage rates were in the 2 to 3% range. That happens a lot whenever interest rates go down. Same thing with vehicles. You might be inclined to go buy a new vehicle. You might be inclined to refinance your vehicle to a lower rate. It essentially saves you dollars down the road in interest costs. Again, on the downside, though, whenever interest rates do go down, there is also more competition whenever it comes to the mortgage market or to the home buying market. There are typically more people wanting the same house. So even though you might save money on a lower interest rate if you're buying a whole new property, what you might find happening is the cost of the home then goes up because there's more demand, there's more competition, there's more offers coming in at over asking. And if you were a seller recently in real estate, you might have taken advantage of that if you sold kind of around the COVID time. So there's pros and cons with higher interest rates, with lower interest rates. Just because you see a hike in rates, as of the date of this recording, it's June 15th, they are saying that the Fed might have a rate hike at some point this year of another 25 basis points. Or if that happens, sometimes the news media, they pick it up and they say, oh my gosh, the world's falling apart. How much longer can we go with these higher interest rates? It's not all doom and gloom. There are pros when it comes to higher interest rates. It's just important that you know how you can take advantage of that and how does that affect you as a consumer and as an individual when it comes to your finances. Another effect that higher or lower interest rates might have on you as a investor, maybe in your 30s or 40s, is whenever interest rates go up, bond prices come down. There's an inverse relationship. When interest rates come down, bond prices go up. So whenever you see bond prices decline, your first thought might be that you have to go out there and you have to sell your entire bond allocation because, oh my gosh, these are going down and I'm going to lose money on it. Bonds and fixed income works a little different from the stock market, especially if you have a timeline until retirement or until you need to use your portfolio of 20 to 30 years. In that case, the timeline for us to use those funds is a whole lot more important than what's happening in the short term with the rises and declines of those interest rates. So let's talk about what you as a consumer should do in a high rate environment, which we sort of are in currently in this time of year. Whenever you have a high interest rate environment, the number one thing that you want to really do is to eliminate as much debt as possible. And I know that's easier said than done. It's not as easy to just go out and just pay off all your debt and be done with it. Really, more so, what I mean by that is if you have a need to use a credit card, but at the same time, you do have some cash stashed away, it might be a good idea. Again, this is hypothetical. You'd have to know the entire situation, but it might be a better idea to use some of that cash to pay off this expense that you might have rather than taking out a loan of 10% interest rate, right? Let's say we were talking about a car loan. It might be better to maybe put a higher down payment, if at all possible. That will lower how much interest that you have to pay out of pocket. And then you could pay yourself back and refill that cash bucket if you have it. This is why also in a high interest rate environment like right now, there are a lot of people that are purchasing homes in cash. Again, you have to have that flexibility to afford that type of a decision. And that's one of the things that we always work with our clients is how do we get to that point of our lives to where we have the flexibility to say, you know what, I want to buy a new property. I'm going to pay cash or should I take a mortgage? But this is where weighing those decisions becomes a whole lot more important because sometimes paying cash makes a lot more sense than taking out a mortgage. On the other end, I'm not saying mortgages are bad whatsoever. If you have a mortgage with a low interest rate, and by that I mean 3, 4%, it's sometimes better to actually hang on to that mortgage for as long as you can rather than paying that off early and adding additional dollars towards your mortgage. Again, depending on what you can get out of the market on average, if you are confident that market returns are going to be, 1, 2, maybe 3% or more higher than what your mortgage rate is, you just by doing simple math should be better off investing those dollars rather than paying off that mortgage early. Again, talking about you having a lower interest rate towards your mortgage. I get that question a lot of I've been stashing money aside or I've been making extra payments towards my principal of my mortgage. I can't wait to be done with it, right? Because I saw that advice somewhere online. It's not always the right advice. It really depends on what interest rates you have, what your goals are, and really what's going to save you the most money down the road. So I'll wrap it up with this. Don't make drastic moves whenever you see a headline of the Fed raising interest rates. It's more than anything important to understand how interest rates work, how interest rates affect you. It's important to have a plan in place on what you're trying to achieve in life financially or personally, and how are these rates going to affect your ultimate financial plan. And if you have any questions about interest rates, or if you ever want to talk about interest rates, feel free to reach out to me. You can find my contact information directly on our website, wealthandplan.com. In addition, if you've made it this far, please subscribe to our YouTube channel. I would greatly appreciate it. It allows other people to see our content. And I will also cross-post this podcast to Spotify and Apple Podcasts. The highlight, as always, are available on LinkedIn and Instagram. So feel free to follow us on those social platforms as well. And as always, with all of my videos, with all of my podcasts, they are for educational purposes only. They are not investment advice. Everyone's situation is a little different. So definitely talk to a financial professional before you make any of these decisions. And thank you again, guys, for listening. And I hope to see you here next week. Bye-bye.